You open your banking app on a random Tuesday. There's no paycheck coming in today. But there's still a deposit sitting in your account. It came from a company you've never worked for, in an amount you didn't have to ask for. This is what living off dividends actually looks like. And the number required to get there is not what you think. Most people guess a dividend income requires a fortune, something in the $10 million range, reserved for people who inherited money or sold a company. That guess is wrong in one direction, and it's dangerously wrong in another. The real number is smaller than the myth. But the path most people take to get there is far riskier than they realize. Let's start with the math nobody walks you through. Say you want $60,000 a year in dividend income. That's a modest, middle-class living in most of the country. The S&P 500 today yields somewhere around 0.3% to 1.5% in dividends. Divide $60,000 by 1.4%, and you land near $4.3 million. That number stops most people cold. It sounds impossible, so they abandon the plan entirely, or they chase a shortcut instead. The shortcut is where things get dangerous. Instead of index funds yielding barely over 1%, people go hunting for stocks yielding 8%, 10%, even 12%. On the surface, the math looks incredible. A $750,000 portfolio at 8% produces that same $60,000. Suddenly, the dream feels close. But here's the problem almost nobody explains to you. Jeremy Siegel, the finance professor behind Stocks for the Long Run, has spent decades studying long-term market returns. His research shows something uncomfortable. Unusually high yields are rarely a gift. They're usually a warning sign. A stock yielding 10% often got there because its price collapsed, not because the company started paying out more cash. The yield goes up. The business underneath is often dying. This is called a yield trap, and it explains why so many income-focused investors end up poorer, not richer, chasing exactly the number they thought would set them free. There's a second cost hiding inside that same trap, and it's one most yield chasers never see coming: taxes. Qualified dividends from healthy, stable companies are taxed at favorable long-term capital gains rates. But a lot of ultra-high-yield stocks, especially certain REITs and closed-end funds, pay distributions taxed as ordinary income. Or worse, they're a return of your own principal disguised as a payout. You can spend years congratulating yourself on a fat yield while quietly funding it with your own capital. So what actually works? To answer that, you have to separate two ideas that get mixed together constantly: dividend income and total return. Dividends are just one way a company returns cash to you. The other way is price appreciation, the stock simply becoming worth more over time. John Bogle, who founded Vanguard and built the modern index fund industry, spent his career making one argument over and over. What matters isn't which bucket your return comes from. What matters is the total return, after fees, after taxes, compounded over decades. Here's where the picture shifts. You don't need a portfolio that generates 100% of your living expenses purely from dividend checks. You need a portfolio large enough that a reasonable, sustainable withdrawal rate covers your life. This is the same math retirement researchers use. Financial advisor William Bengen ran the numbers in 1994 that became known as the 4% rule. Using historical market data going back to the 1920s, he found that a retiree who withdrew 4% of their portfolio in year one, then adjusted that amount for inflation every year after, could make their money last even the worst 30-year stretches in market history, including the Great Depression and the stagflation of the 1970s. Under that framework, funding $60,000 a year doesn't require $4.3 million. It requires $1.5 million, growing through a mix of dividends and price appreciation, not dividends alone. That's less than half the number the dividend-only myth demanded. Let that sit for a second. The barrier was never actually the wall people imagined. The wall was built from choosing the wrong tool to climb it. Later research on Bengen's own model added a wrinkle worth knowing about. Sequence of returns risk. Two people can retire with the exact same $1.5 million and the exact same average annual return over 30 years, and still end up with wildly different outcomes, purely based on whether the bad years hit early or late. A market crash in year 1 of retirement does far more damage than the same crash in year 20, because you're pulling money out while the balance is still falling. This is exactly why relying only on dividend checks and never touching the underlying shares has quiet appeal. It sidesteps some of that sequencing risk, since you're not forced to sell shares at a low price just to generate cash. But it only works if the yield is real and sustainable, not the product of a collapsing stock propping up an inflated percentage. There is a middle path worth naming here, because it's real, and it's not the same as chasing yield. It's called dividend growth investing, and it focuses on companies known as Dividend Aristocrats, S&P 500 businesses that have raised their payout every single year for at least 25 consecutive years. Coca-Cola, Johnson & Johnson, Procter & Gamble. Their current yields usually look modest, often 2% to 3%, nowhere near the 8% headline number that lures people into the trap. But the payout itself grows year after year, often faster than inflation, which means the income you receive against your original purchase price keeps climbing even when the quoted yield looks unremarkable. A stock bought in 2005 yielding 3% at the time can easily be paying its original buyer 8% or 9% against that same initial investment today, simply because the dividend kept rising while the entry price stayed fixed. That's the quiet difference between a company being pressured into a high yield by a falling stock price and a company earning its way into a rising one. Now picture what this actually looks like day to day. You're 34 years old. You put $800 a month to a low-cost, diversified index fund. You don't touch high-yield stocks chasing an 8% dividend number, because you understand now what that yield is often hiding. Historically, the S&P 500 has returned close to 10% annually before inflation, and around 7% after adjusting for it. According to data Robert Shiller, the Yale economist and Nobel laureate, has tracked across more than a century of market history in his long-term stock market datasets. At that pace, $800 a month compounds past $1.5 million in a little over 28 years. You'd be around 62. Not a fantasy. Not if you inherit money. A math problem with an actual ordinary solution if you start early enough and let compounding do the heavy lifting instead of chasing yield. Push the timeline and the contribution just slightly, and the outcome moves fast. Start at 25 instead of 34. Raise the contribution to $1,000 a month as your income grows. Reinvest every dividend along the way instead of spending it. Under those same historical return assumptions, you cross $1.5 million before for 55, a full 7 years earlier, without ever touching a single high-yield stock. Thomas Stanley, the researcher behind The Millionaire Next Door, studied actual American millionaires for decades and found the same pattern again and again. Most of them didn't get there from a dramatic high-yield bet. They got there from ordinary income, consistent investing, and enough patience to let ownership of businesses, not chasing income from them, do the compounding. Here's the counterintuitive twist most people never hear. The investors who focus obsessively on maximizing dividend income right now often end up with less total wealth than investors who ignore dividend yield almost entirely. Chasing yield concentrates your money into a narrow slice of shrinking, distressed companies. Ignoring yield and investing broadly captures the entire market's growth, dividends and price gains together, compounding as one number instead of two competing goals. This is the part that reframes everything. You were never actually trying to build dividend income. You were trying to build enough total wealth that your money could pay you, in whatever form made sense, forever. Dividends are simply the most visible, most emotionally satisfying slice of that much bigger number. The deposit that lands without a paycheck feels different from watching a portfolio balance rise, But mathematically, by year 30, they're often the exact same dollar. So bring this back to today, to your own account, to the number sitting in it right now. You don't need $4.3 million. You don't need to find some secret 12% yielding stock nobody else has discovered. You need time, a low-cost diversified fund, and the discipline to let compounding run for 2 or 3 decades without interrupting it out of impatience or fear. The paycheck stops. The deposit doesn't. And when you open that banking app on some random Tuesday decades from now, the number sitting there won't feel like a myth anymore. It will just be math, finally caught up with you.